Will the Fed buy stocks? Short answer, yes. I'm going to explain why in 3 simple, fast steps. Step number 1, it starts with the cerveza sickness reality. We've got your friend and family member Fred always telling you that, hey, this is just the flu. But the difference between the people that get this and don't, the quote that I like to use from Wayne Gretzky. Editor, go ahead and throw up the quote. I skate to where the puck is going to be, not where it has been. So the mistake your friend and family member Fred is making is they're looking at the numbers as they are right now and ignoring what the numbers will be in 2 weeks, 3 weeks, 4 weeks. The data points that you really need to focus on to get your head around this, or try to encourage your friends and family member like Fred to do the same. The R naught value of the cerveza sickness is 4.08. We'll call it 4 for the flu, 1.28. Why is this a big deal? Go right over here. Very simple. For every one person that has the flu, they spread it to 1.28 people. So if you go through this cycle, call it 3 times, maybe you have a total of 4 people that are infected. If you have an R naught value of 4, every one person spreads the virus to 4 more people. So after the same 3 cycles, you now have 1, 5, plus 16, 21 people infected. You can see what happens after 3 weeks, 4 weeks, 2 months, and how this grows exponentially. The second key metric that's extremely important is how many people require hospital beds. The cerveza sickness, 10%, and that's being extremely conservative. The flu, 1%. For a moment, let's assume the exact same number of people get the cerveza sickness as the flu. Generally with the flu, 20 million a year. So the flu would require 200,000 hospital beds. Cerveza sickness would require 2 million hospital beds. Now you're starting to understand the problem. How many hospital beds do we have in the United States? 900,000. The problem, 68% of them are typically in use with people who have other healthcare needs. That leaves us with 288,000 beds available for 2 million people who need those beds because they've been infected with the cerveza sickness. This is why the death rate, if it is low, doesn't really matter, because if our hospital system gets overwhelmed, that death rate will go through the roof. We also need to understand that this isn't something that just happens in 3 days or 3 weeks and boom, it's done. It can last months, often the entire year, going down a little bit in the summer, but coming right back in the fall, and actually much worse in the fall than it was in the spring. To understand this better, let's go to yesterday's Joe Rogan podcast, where he interviews a specialist.
When we call something an incubation period, we're talking about from the time you and I got exposed, meaning I was in a room breathing the air that somebody else who was infected with the virus was expelling out, I breathed it in. How long from that time period till the time period that you get sick? And what is that? That's what we call the incubation period. So that's when case numbers can double or triple in every so many days. In this case, it's about 4 days. Because you and I might get exposed to somebody who is totally asymptomatic, no symptoms. That virus would appear, well, that's not a very strong virus. But in fact, when it infects us, it could kill us. So we've seen cases of fatal disease that were exposed to people that had minor symptoms themselves. Joe, we really have got to get information out to the public. There is so much misinformation right now. And, we're going to be in this for a while. This is not going to happen overnight. And I worry, I keep telling people we're handling this like it's a corona blizzard, 2 or 3 days, we're back to normal. This is a coronavirus winter. And we're going to have the next 3 months or more, 6 months or more, that are going to be like this.
An incredible interview. We'll put a link in the description below. The next thing your friend and family member Fred is probably saying is, look at China. They're doing all right. They had a big problem, but the infection rate is really flattened out. It's smooth sailing from here. What he doesn't understand is, number one, the numbers most likely aren't accurate. If you look at pollution reports or traffic reports, you'll see activity is still very, very low. The second thing that he doesn't understand is China took draconian measures, to say the least, to make sure this R0 value went from 4 all the way down to 1 or hopefully lower. Are we prepared to do that in the United States? And if we are, what will that do to the economy? We'll get into that in steps number 2 and 3. But I want to go back to the Gretzky quote, where he wants to look at where the puck is going to be and not where it's been. If we take that advice, we have to look at some of the risk factors that are exclusive to the United States that nobody is talking about, that could make this far worse in the US than we've seen it anywhere else in the world. The risk factors we know of are old people have a really hard time with this, and if you smoke. Since it's a respiratory infection, that would make sense. But there's another third factor that, again, nobody's talking about, and this could have a huge impact on the Americans who actually get this virus. For more on that, let's go right back to the Joe Rogan interview.
There are a series of risk factors that we worry about that, if they overlay on this disease, are going to cause bad outcomes. And we happen to be right at ground zero for one of the major ones here in this country, and that's obesity. We know that obesity is just like smoking in terms of its ability to really cause severe life-threatening disease, and 45% of our population today over the age of 45 in this country are obese or severely obese, and there's men and women. So one of the concerns we have is we're going to see more of these, what I guess I would call very serious and life-threatening cases occur in our country because of a different set of risk factors than we saw in China.
Step number 2. Now that we understand the severity of the cerveza sickness, we have to realize that the economy equals the stock market, whether we like it or not. Got a chart going back to 1972, 2020. This is the market cap to GDP, 25 up to 45. Crashes down in the early 70s, and it's really cheap in here, maybe 55% of GDP at the most. In 90, we go through the internet boom and bubble, takes us all the way to 147% of GDP, crashing down to 2002, goes up a little bit with the housing bubble, comes back down again, the GFC. Since then, with quantitative easing, money printing, artificially low interest rates, back to an all-time high, 158% of GDP. We've come down since. As you know, the last couple weeks, the market has tanked, but we're still at 138% of GDP. If it goes down as far as it did in 2007 to those levels, which, as most of you know, is very possible, that takes us to 70% of GDP. In other words, the market cap, or how much money people have in the stock market, how much paper wealth they think they have, goes from 27 trillion all the way down to 13.5 trillion. Think of the amount of purchasing power that's lost by the stock market going down to 2007 levels. And that's assuming it doesn't go down to 1981 levels, which would take us to 40% of GDP, far lower than we were even in 2007, 8, and 9. Just in the 401ks, there's $3.8 trillion. But that's just talking about the asset side of the equation. There's also the corporate bond market, which is far more important. If stock prices crash, the corporate bond market blows up. If you don't know what I'm talking about, we discussed that extensively in Monday's video. Link in the description below. The corporate bond market blows up, unemployment goes through the roof. Of course, that affects spending dramatically. There's also the gig economy. How many of your friends make ends meet by driving Lyft or Uber, or maybe renting out their place on Airbnb? All these companies bleed money. They go to the junk bond market and pay X interest rate. If that bond market blows up, the interest rate they pay doubles, triples. Most of these companies will go out of business, and all your friends that make ends meet with the gig economy now have real problems. It all goes back to Ray Dalio's explanation how an economy works. One man's spending is another man's income. To get a refresher, let's go right back to the clip from Ray Dalio's video.
Remember, spending drives the economy. This is because one person's spending is another person's income. Think about it. Every dollar you spend, someone else earns, and every dollar you earn, someone else has spent. So when you spend more, someone else earns more.
The video does a great job of taking something extremely complex like the economy and really simplifying it. Although I would point out that there is no spending without producing. And you guys know that from watching my videos, but that's a completely different topic. The bottom line, if we have a stock market collapse, we go into a doom vortex. Lower asset prices means higher unemployment, lower purchasing power. But the lower the purchasing power goes, the more unemployment we have. The more unemployment we have, of course, the lower the purchasing power. This is in an economy where 70% of GDP is consumer spending. This is why I say the economy equals the stock market. Step number 3. We know the severity of the cerveza sickness, and the stock market now in 2020 equals the economy. But we still haven't answered the question, why will the Fed buy stocks? Because they don't have a choice. Let me explain. Fed has two tools at their disposal: interest rates, quantitative easing, or money printing. The other day, the market is in free fall. Fed comes right in and says, whoa, we've got to stop the carnage. An unexpected rate cut of 50 basis points. The market looks at the Fed and says, yeah, homie, don't play that. They puke it right back up. Market still goes down 700 points. And let's remember, the Fed is now at 1%, so they only have 100 basis points left before they get to the zero bound. So we can cross interest rates off the list. Then Steve Leisman comes in and says, whoa, wait a minute, we can just do quantitative easing. That's worked in the past. The Fed, they're all geniuses with PhDs. We have nothing to worry about. Really? Let's explore how quantitative easing actually works to see if it may be a viable solution. The Fed goes to all the primary dealers and the banks under their umbrella. They buy treasuries, T-bills. To pay for these assets, they print up all the funny money and put it into the reserve accounts the banks have with the Fed. In order to get the reserves into the financial economy to buy stocks, it requires the banks to make a decision. Either they can buy those shares themselves, or they can use the reserves to lend to hedge funds and other financial institutions that will then take those newly formed deposits and buy shares, taking the stock market up, up, and up. Whoa, time out. You know the Fed understands the problem just as well as I do, because they're already talking about buying stocks. Editor, roll the clip.
Eric Rosengren had earlier said that the Fed needs to think about using additional tools. Those tools could include, for example, a wider array of asset purchases beyond just treasuries and agency-backed securities.
The point is, the Fed doesn't have a magical light switch they can turn on and off, directly impacting the stock market. What about fiscal spending? We've all heard from the administration and Trump himself, this is a panacea. They're going to handle the problem. They've projected $8.3 billion in additional spending, who knows where that's going, and a payroll tax cut. I've heard up to 1 year. What they're not thinking through is the deficit and unemployment. To explore the problems, the additional problems we would have with the deficit if they eliminated the payroll tax, let's go right to the charts. Sources of federal tax revenue going back to 1945, 2015. It starts around 5-10% at the most of the entire tax revenue pie. Moving on to the modern day, it's over 30% of tax receipts. So if you eliminated a payroll tax, our $1 trillion deficit would explode to well over $2 trillion. One more thing I'd like to point out, the total tax receipts as a percentage generated from individual income taxes stays very consistent regardless of whether the top marginal rate is 90% like it was in the 50s or 25% like it was in the late 80s. The biggest thing affecting income taxes and how much is paid is not the highest marginal rate, but it's the direction of the stock market. And there's the additional unemployment. How is a payroll tax cut going to increase the spending of someone who doesn't have a job or a business that's gone bankrupt because the stock market's crashed, the corporate bond market's blown up and decimated the real economy? The takeaway for the Fed and the government is anything they do requires a third party to take action. They don't have total control. You may be saying to yourself, yeah, George, I get it, but this just sounds like libertarian crazy talk. I remember back in 2008, the Fed came in, dropped interest rates, did quantitative easing. The government was bold in their approach with their fiscal spending, TARP, and bailouts. They saved the day. Why can't they do that again? What you're not understanding is how significantly different the problem is in 2020 than it was in 2008. The catalyst to the whole financial system imploding back then was the asset side of the bank's balance sheet had all this garbage. You remember mortgage-backed securities, and of course our favorite, OPA, oceanfront property in Arizona. The Fed was able to paper over this problem, put a Band-Aid over it, and kick that can further down the road simply by printing up all this funny money, putting it into the reserve accounts of the banks, and taking that garbage off of their balance sheet. The banks were then solvent again and could move forward. The damage to the real economy was people had less home equity, but they were still traveling. They were still going to the mall, going to restaurants, going to their kids' soccer games. Although they were doing it less, it didn't drop down to zero. The big difference is back then, although these people were obviously pissed because they lost a ton of home equity, at least they were outside of their house doing things. What we might see in the next couple months in the United States is people aren't even outside. They've locked themselves inside their house, wearing a face mask, eating canned goods, doing everything they can to avoid getting the cerveza sickness. This is a completely different economic animal, and it's something the Fed nor the government are prepared to handle. No amount of quantitative easing, interest rate drops, money printing, or the government spending will handle this type of problem. How are you going to get these people to go out and buy stocks just because you do quantitative easing or give them a little payroll tax cut? How are you going to force the banks to take these reserves and buy the stock market just because you drop interest rates? You can't do it. And this puts the Fed into a position of, instead of being the lender of last resort, they are the buyer of last resort. That's why I'm confident that if we get into a China or even an Italy type situation in the United States, you're going to see the Fed come in and buy the stock market. For more content that'll help you build wealth and thrive in a world of out of control central banks and big governments, check out this playlist right here, and I will see you on the next video.